For years, I've been telling clients to invest through a bucket company. You have the trading company up top, a family trust sitting in the middle, and surplus profits flow to the bucket company that pays 30% and lets the money compound. I've drawn that exact structure in half of my videos on this channel. It's the thing I'm probably best known for. The budget just made it unworkable. So I want to be straight with you because a lot of you set this up on the back of advice like mine. I'm going to show you what's changed, why the bucket company piece no longer works, and the new structure I'm moving clients into instead. I'll do a quick recap because most of you watching are already in some version of this. Here, you've got your trading company. That's the business structure that earns the profit. Instead of pulling all the profit out into your name and getting smashed at 47%, you distribute the surplus to a family trust and the trust sends it down to a separate company known as a bucket company where it gets taxed at 30% and stays there to be invested. The trust owns the shares for asset protection and estate planning, and the bucket company does the heavy lifting on the tax. And up until budget night, it worked beautifully. There are two changes here. The first is a 30% minimum tax on discretionary trust distributions starting from 1 July 2028. So income that used to flow through the trust and get taxed in someone else's hands at their own rate now gets taxed at a 30% minimum on it no matter what. For a lot of structures, that's an extra cost where there used to be very little. The second change is the one that kills the bucket company. When a trust distributes to a company now, the company gets no credit for the tax the trust has already paid. So watch what happens to the money. The trust earns $100 and pays its 30%, so $30 gone. It sends the remaining $70 down to the bucket company and the company pays 30% again with no credit for the first $30. So that's another $30 tax. And this leaves the company with $40 out of the $100 it started with. So no one's going to run money through a structure like that. So the bucket company, as a place you route money into, is dead. Rest in peace. Here's what tells me this wasn't an accident. The budget papers go out of their way to carve out corporate beneficiaries from the credit. They specifically say they're doing it so people can't cycle income through a bucket company to get around the minimum tax. They even flag that they'll consult how trustees use their leftover franking credits, which is just government language for we know about the workaround and we're closing it. Then, in the same breath, they offer 3 years of rollover relief to help you restructure out of a trust into a company without triggering capital gains tax. And the papers actually talk up how much better companies are than trusts because a company lets you retain profits at the lower 25% tax rate and makes it easier to raise finance. So, they've made the trust more expensive, blocked the bucket company workaround, and rolled out the red carpet into companies. So, this is the part you actually came for. What do you do instead? The model I'm moving clients to is this. You keep the trading company, but the trading company is owned by a holding company and the holding company is owned by the family trust. So it's still 3 entities in a different order. Now, you might be asking why the trust stays at all when the whole problem is the trust. And the answer is risk. If you're the one running the business, especially anything with professional liability, like a lawyer, engineer, or an accountant like me, you do not want to be holding those shares in your own name because the investments building up underneath become an asset. An asset someone can come after. I've never held our investments in my own name for that exact reason. I could put the shares in my spouse's name, and some people will do that, but then every dividend has to come out to that person, and you've lost all your income splitting. So you're stuck choosing between asset protection and tax flexibility. The family trust is what gives you both, and which is why it needs to stay. Here's how the money moves through the new model. The trading company pays its 25%, and when that dividend flows through to the holding company, it gets taxed at 25% again. So there's no extra tax at that level because the rate is the same the whole way through. That's actually better than the old bucket company, which in most cases was paying 30% in tax. So the money sits and invests inside the holding company at a lower tax rate than before. Then, when eventually it comes down to the trust tops it up to the minimum 30%. So you're paying that little bit extra. And from there, it goes out to the beneficiaries. And as long as they've taken a wage first, it stays tax effective. That last point is the key to making the trust work under the new rules. You pay each person a wage of around $45,000 to $50,000 to use up their lower tax brackets, because after that, the individual rates climb past 30% anyway. Then the trust distribution sits on top of that wage, so the 30% credit actually gets used instead of going to waste. Because if you skip the wage and just distribute straight to someone with no other income, you'll end up paying more under the new rules, since the trust's flat 30% is higher than the average rate that person would have paid in their own hands. Now, if you went company only, no trust, this budget isn't the end of the world for you either. I've said for years that I wouldn't run a business or an investment portfolio through a trust. And a lot of people push back on that. That position just got validated. Everyone's heading towards companies, whether they like it or not. But company-only people aren't completely off the hook. I sat with a guy this week who owns 35% of his trading company in his own name. He takes a wage of around $80,000, and then there's a $300,000 dividend on top. And he's paying tax all the way up to the top tax rate on income of around $480,000, including the franking credit. He set up the company years ago with himself as the shareholder and never revisited it. All we need to do here is insert a holding company underneath. So the dividend comes down to the holding company, and he keeps what he needs to live on. The rest stays and invests at the company tax rate. We just did this for 2 business owners in that exact situation, gave them a holding company each, and it sorted both their annual tax and how they're going to invest moving forward in one move. Plus, there are rollovers available allowing you to do this without any capital gains tax. So even with no trust, if you own trading company shares in your own name, there's a simpler structure sitting right there. But whatever situation you're in, the mistake I'm already watching is people panicking and trying to do a restructure straight away. Don't. The new rules don't kick in until the 2029 financial year. So for this year and the next year and the year after, the bucket company still works exactly as it does now. You've got a 3-year window where nothing has to change. We're not setting up any new bucket companies at this point, but we're not tearing existing ones apart either. And there's a real reason to wait beyond just the timing. This isn't even draft legislation yet. It's an announcement. It has to go through a consultation process, and I think the bucket company carve-out is going to get a lot of pushback. There's also an election due before the trust changes start in May 2028, with the new rules landing 1 July 2028. So there's a genuine chance some of this gets watered down, or they keep the 30% trust tax but bring the bucket companies back. We just don't know yet. So the right move right now is to sit tight. Keep using what works while it works, and have your transition mapped out and ready before that rollover window opens July 2027. If you've got a trust in your structure, and especially if you set up a bucket company off the back of one of my videos, this is the year to get it reviewed. Not to rush a restructure, but so you know exactly what a transition looks like before the rollover window opens and you're not making the decision under some sort of time pressure. In the meantime, if you want to see how a high profit business can avoid paying 47% tax and then pay no tax at all when the business sells, watch this video here.